Hey guys, and welcome back to FSM Trading. Today we're going to be talking about the top 5 stocks I believe that give you the best dividend yields. I'm going to take you through each one in detail and let you know why I think you can be gaining the most in terms of your dividends off of these. What is a dividend? This means that the company is effectively going to pay you for believing in them, for having their stock, for holding on to their stock. They're going to pay you, and that comes out of their earnings. So first on my list, we're going to go with Altria. Having a look here, we can see Altria is the biggest tobacco company in the world. This obviously article talks about the resilience of big tobacco. The reason for that is because they did start to take a big hit. As you know, the tobacco industry, the cigarette industry as a whole, took a big hit because of dual, meaning vaping. Everyone was turning to vaping, but it looks like that tobacco is beginning to resurge, and this would be the biggest company to do it. I would be backing them all the way. So they're currently operating around $40, 52-week low of around $30, 52-week high of around $51. Market cap is $75 billion. They also have, there we go, the dividend yield, 8.52%, a PE ratio of 104.91, earnings per share, 38 cents. But how huge is that? 8.52% per annum for holding on to this particular stock. So really huge. I mean, we can see a few of what the analysts say here. I mean, the current price is around $40, as we said, but also the average in terms of target price is looking around $47. So looking to increase. This looks like a strong buy at the moment in terms of what analysts believe. Also here, main news that we can look at in terms of the dividends. Yes, it's at 8.52%, but we can also look at the payout ratio. It's around 81.52% trailing the last 12 months. So that means effectively that based off their earnings, 80% of what they pay goes to their dividends. So that is quite high, given that obviously a lot of their money that they're getting in is going to their dividends. Why is that not sometimes the best thing to look at? Always, because that means that they're having to find money from other sources to bring in to make up for that shortfall if they give it, because they're going to have to pump some money back into the company, which produces growth. So Altria maybe a bit more, I would say, risky, but there we can see 11 years of consecutive dividend growth. They've always been able to deliver for 11 years consecutively. So maybe one that's a bit more risky, but still a very, very good one. 8.52% dividend yield, extremely high, especially in times like these. It might be something that someone might want to take the risk on. Number 2, we're going to look at one of the biggest telecommunications company, AT&T. You've probably had a contract with them. You might just not know. One negative to already start off with AT&T is they have got $150 billion debt. That is only because they had an acquisition of Time Warner, as we can see here in this this article, but also they have obviously been improving their network environment and looking at 5G. They're one of the biggest providers of 5G networks at the moment, and they're said on their website to be the fastest nationwide. So looking at some more stats, we can see they're currently trading around $29, 52-week low of $26, so they're coming down a little bit, 52-week high of $39, 206 billion market cap, PE ratio of 19.12, extremely high, earnings per share of $1.52, 7.17% dividend yield. Now, for me, I'll let you guys know, I think this is the safest option out of all of the dividend stocks I've put down as my number 2. Maybe Leggett Platt, which we'll come on to as my last dividend stock, but I think that this is a sure bet, to be honest with you. I don't even think it's gambling. I think this one is definitely scheduled to go up, and we can see here what the analyst predictions are. Its current price is around $28. They do predict a target price of around $31.17. And further than that, getting into some of the most important news on the dividends itself. Dividend yield, as we said, around 7.17, but its payout ratio is very, very, very good at 58.26, meaning that 58% of the money they earn from earnings goes into its dividends, and they've been doing that consecutively for 36 years. That's what you want to see in a company, and that should give you, the sort of confidence that you're going to be looking for as a dividend investor. As you can see also here, it's got a dividend frequency of every quarter they look to pay out. So that's 2 down My number 3 would be the largest insurance company on the London Stock Exchange, and that is Prudential Financial. I believe it's a definite buy for me. I 100% believe that there's a lot going on there, but definitely some scope to improve. We can look at some stats here. $78 trading at the moment, 52-week low of $38, 52-week high of $97, and a huge market cap of 30 billion. We can also see that it hasn't got a PE ratio, and that's because it's probably trading negatively at the moment. Earnings per share are also negative 35 cents, but a good dividend yield of 5.63. So that might scare people a little bit, the negative growth in terms of earnings per share and negative PE ratio. But it isn't earning at the moment. But the reason it's in here is because of its substantial dividend yield. And we can take a look at some stats to support that as well. I mean, let's see what some of the analysts are saying. Its predicted price, it should target price is around $73, and its current price is around 78. So it's still on a decline. It's still likely to drop a little bit in terms of market share, in terms of share price. I think it would come down a little bit, but I'm talking future wise. I think this is a great dividend stock, and I think we can see future growth for this particular one. And looking at some important news here, or some important stats, we can see, yes, the dividend yield is 5.63, but also its payout ratio is around 37.64%, which is very good. But the only issue I would have here is that it's only been consecutive growth, or dividend growth has been 1 year. So this would be at the bottom of my list. It's a bit more risky, but it is still in there as my top 5. So a bit more risky if you want to look outside of what you originally or looking to invest in. Prudential would be one on my list, but maybe just a bit further down. Number 4, penultimate one, would be Exxon Mobil. I think there is a lot to be done with this particular one. Oil and gas has obviously taken a huge hit in the market. Obviously, because of COVID, we saw negative growth at one stage in the oil industry, and gas on Exxon Mobil do as well. But why is it in my list? We can see here some stats here. $40 currently trading at, $30 as a 52-week low, and $71 as a 52-week high. 169 billion market cap. We can also see a positive 51.66 PE ratio, and also earnings per share at $0.78. Its dividend yield is 8.66. This is huge. I would say this is probably number 3 on my list. It's still quite risky, but it's because of oil and gas industry at the moment, but definitely is still one that I would consider getting in on, because of oil is starting to come back up now and starting to improve in price. I mean, Exxon is growing at a fantastic rate at the moment. I mean, analysts are saying at the moment that they predict its price to go to around $45, and its current price is around $40. So still positive, still a strong buy in my opinion. And looking at further into the dividend stats, we can see that it's got a payout ratio of 154%. Now that is extremely scary maybe for some people. What that actually means is that they're actually paying more in its dividends than they are actually earning in their earnings, which is quite scary, meaning that they definitely have to find other sources of finding money to give to their investors. But the problem with that is that they're not pumping any money back into their own business to see it grow. So definitely very scary, but they've been doing this consecutively. Dividend growth, they've been paying out for 13 years. That's a little bit of how the industry works in oil and gas. They do have payout ratios higher. Why is that? Also, the payout ratio might be higher just because the industry has been falling for the last, 12 months because of COVID, etc. So what tends to happen is that the payout ratio increases. So these are a few of what I think. I have Exxon in my own portfolio. I would still say it's still a strong buy. 13 years of consecutive dividend growth. I don't think it's going to stop paying, this year or next year. So still a strong buy for me. Lastly, Leggett Platt. This is probably one of my favorites as well. Maybe number 1, maybe number 2. Take your pick with number 1. The first one I've discussed with you guys is AT&T, number 2, or this one, Leggett Platt. These guys specialize in designing, producing things for like home environments and also automobile environments. But they have beat their Q3 estimates just recently. We're now into Q4, but Q3 they beat their estimates. It's been going up since then, and we can see it here currently trading at $44. It's 52-week low of around $22, 52-week high of $53, 5.87 billion market cap. It's got a PE ratio of 26.04 and an earnings per share of $1.70. Its dividend yield is slightly lower than the rest, but it's 3.61. But because of that, I can trust it a little bit more. It is positive, and we can see what some of the analysts are saying also. And for me, they're still saying it's likely to be a buy signal here. Current price $44, and they're a target price of around $47. So still good. I mean, some of the interesting stats we want to look at, I mean, we can see that its payout ratio, again, very, very strong at around 62%, meaning 62% of its earnings are going back into its dividends. Quite strong. They've been doing this for around 49 years, consecutive dividend growth. So I mean, it depends what you're looking for. If you want to look a bit more risky at some of the ones we've done, we can look at Altria. If we want to play it a bit more safe, we can look at AT&T. We can also look at Leggett Platt. Maybe a bit more risky, still looking at Prudential. And in the middle, I would say, is Exxon. So a wide range for you to look at there in terms of dividend stocks at different rates and different percentages, but all of them strong. And most of those are in my personal portfolio. So please do, if you've enjoyed this video, I want you to like, share, subscribe. Please do click the notification bell to be kept updated on all of the other videos I've got coming out on the page. Thank you for listening, guys.